You work in Switzerland, you pay your taxes, and a part of your salary is building your future retirement. But unlike many countries, your Swiss retirement isn't one big savings pot. It's actually three distinct systems working together, and understanding each one is key to knowing where your money goes, how it grows, and what you can expect when you eventually stop working, or even if you leave Switzerland. When you work in Switzerland, you're not just earning a salary, you're building towards your future retirement. But this isn't a single simple savings pot. Switzerland's unique approach to retirement provision is built on three distinct pillars. Think of these as three interconnected financial safety nets, each serving a different purpose and contributing to your overall financial security in retirement. Understanding how these three pillars work together is essential, whether you plan to retire in Switzerland or move on later. Let's begin with Pillar 1, the state pension. This forms the foundation of the Swiss retirement system. Its official name is AHV, also called AVS. Pillar 1 is a compulsory social insurance designed to cover basic living expenses. Almost everyone living and working in Switzerland contributes to it, regardless of their income level. Contributions are deducted directly from your salary, and the money collected primarily funds the pensions of current retirees. This is often called a pay-as-you-go system. At retirement, Pillar 1 provides a basic income, but it's generally not enough to maintain your previous standard of living. It's designed as a broad social safety net, not a full replacement for your working income. Contributions are deducted directly from your salary, and the money collected primarily funds the pensions of current retirees. Building on this foundation is Pillar 2, the occupational pension. This pillar connects directly to your employment. Its official name is BVG, also called LPP. If you're an employee earning above a certain annual income, your employer is legally required to enroll you in a pension fund. Both you and your employer contribute regularly to this fund. Unlike Pillar 1, the money in Pillar 2 is held in individual accounts for you, managed by your pension fund. These funds accumulate over your working life, often growing with interest. A key difference with Pillar 1 is that if you change jobs, your accumulated Pillar 2 savings are transferred to a new pension fund, or held in a special vested benefits account until you find new employment or reach retirement. This individual accumulation also means that if you leave Switzerland permanently, there are specific conditions under which you might be able to withdraw these vested benefits before retirement, though some restrictions apply, especially for the portion covering basic old age benefits. Finally, we have Pillar 3, which represents voluntary private saving. This pillar offers flexibility and allows you to supplement your state and occupational pensions. It's often divided into two categories, Pillar 3A and Pillar 3B. Pillar 3A is the restricted tax-advantaged option. It offers significant tax benefits, as contributions can be deducted from taxable income and withdrawals are taxed at a reduced rate. However, there are annual contribution limits, and the money is generally locked in until retirement, with specific exceptions like purchasing a primary home or becoming self-employed. Pillar 3B, on the other hand, is flexible private saving. It has no contribution limits, and you can access your funds at any time. It includes various forms of saving, from bank accounts to investment products and life insurance. While Pillar 3B doesn't offer the same direct tax deductions as Pillar 3A, some cantons may provide indirect tax benefits for certain Pillar 3B products. Together, these three pillars are designed to ensure a reasonable income in retirement, adapting to your personal and professional circumstances. Imagine an international professional, Sarah, who arrives in Switzerland in her 30s. She starts contributing to Pillar 1 immediately. With her first job, she joins an employer's pension fund, building her Pillar 2 savings. Later, she decides to open a Pillar 3A account to benefit from the tax advantages and accumulate extra funds. If Sarah eventually moves to another country before retirement, her Pillar 1 entitlement will remain for later collection. Her Pillar 2 vested benefits could potentially be withdrawn depending on the destination, and her Pillar 3A funds might also be accessible under specific conditions. Pillar 3B funds are generally the most flexible to access upon leaving. The common misunderstanding here is that your entire pension is managed by the government or by a single entity. In reality, it's a dynamic combination. The state handles Pillar 1, your employer's chosen pension fund manages Pillar 2, and you personally choose how to structure Pillar 3. Understanding this three-pillar map empowers you to see where your retirement money goes and to make informed decisions about your financial future in Switzerland. Understanding this three-pillar map empowers you to see where your retirement money goes and to make informed decisions about your financial future in Switzerland. As you navigate your life in Switzerland, how might these three pillars shape your own long-term financial planning?